Congratulations, you had made the learning until now. Now in this learning, you will learn on the basic of chart reading that consists of analyzing the price action of a company's share price or any financial equities. This basic consists of the learning on how to read bar chart and candlestick chart. Technical analysts and chartists use charts to analyze a wide array of securities and forecast future price movements. It boils down to an analysis of supply and demand in the market to determine where the price trend is headed. In other words, technical analysis attempts to understand the market sentiment behind price trends rather than analyzing a security's fundamental attributes. A price chart is a sequence of prices plotted over a specific time frame. Charts provide an easy-to-read graphical representation of a security's price movement over a specific period of time. As far as we can see in the chart, the y-axis, which is the vertical axis, represents the price scale, and the x-axis, which is the horizontal axis, represents the time scale. Prices are plotted from left to right across the x-axis, with the most recent plot being the furthest right. In this chart, we can see the example of bar chart. Bar charts are among popular trading chart types. We will look over on how to read bar chart. Bar charts consist of an opening foot that is facing left. It indicates the first price traded during the day, a vertical line, which is the direction the price has moved, and a closing foot that is facing right, which is the last price traded for the day. In this example, you can see the price increase over the bar time period. This increase in price is called a bull bar chart, and it always indicates by green in color. For bear bar chart, it opened higher and closed lower at the end of the day. It always colored by red to indicate price decreasing over the period. As you can see, each bar chart includes the open, close price, high and low that occur during a specific interval. The high is the highest price traded during the day and is indicated by the top of the vertical bar, and the low is the lowest price traded during the bar and is indicated by the bottom of the vertical bar. According to Nissen candlestick, candlestick charting first appeared sometime after 1850. Much of the credit for candlestick development and charting goes to a legendary rice trader named Homa from the town of Sakata. Candlestick accurately reflect current price with candle form that indicate the domination of buyer or seller in a specific time period. It is in a candle form of image and usually used to identify potential reversal or continuation price of a financial equities. Candlestick charts are read and interpreted as follows. The open is the first price traded during the candlestick and is indicated by either at the top or bottom of the body. The close is the last price traded during the candlestick and is indicated by either the top or bottom of the body. The real body is a price traded between the open and close trading price. A shadow, wick, or tail is a line found on a candle in a candlestick chart that is used to indicate where the price of a stock has fluctuated relative to the opening and closing price. Essentially, these shadows illustrate the highest and lowest prices at which a security has traded over a specific time. The high is the highest price traded during the candlestick and is indicated by the top of the tail that occurs above the body, called the upper tail. If the open was the highest price during the time frame, then there will be no upper tail. The low is the lowest price traded during the candlestick and is indicated by the tail that occurs below the body, which is called the lower tail. The trading range of the day include the price range in between the highest and lowest of the day. While a candle is forming, which is not yet completed during trading hours, the candle will constantly change as the price move. The open stays the same, but until the candle completes, the high, low and close could all change. The color may also change while a candlestick is forming. It may go from green to red, for example, if the price is above the open price but then drops below it. When the time frame for the candle ends, the last price is the closing price, and then the candle can no longer change. A new bar forms to show how the price moves over the next time segment. As you can see, a bullish candle happens when the green candle appears with the price has increased over the time period. This same goes to when the market is downward and forming a bearish pattern. You can see that the open is higher and it closed lower during the end of the day. So this is an example of candlestick in a chart. Bar and candlestick charts are used by technical analysts in the study of supply and demand for a security or commodity in a marketplace. Bar charts use of bars, while candlestick charts shows the use of candles, which also represent the trading range of a security or commodity for a given period. It can give a deeper insight into price action because they are visual and give the user a clear view of relationship between the open, high, low and close of the candle. Candlestick chart reflect quickly the buyer and seller sentiment on a specific time frame. So during the day, we can see buyer and sell dominant in each day. A certain candlestick formation be able to give clue to trader what formation or trend will be in the next few candlestick formation. This helps trader or technical analysts identify price reversal and price continuation. It gives a signal on buyer and seller sentiment change and at the same time signs of precaution and warning on the possibility on the next market movement. Thus, it helps trader and investor to be psychologically prepared on any probability price movement that move against them. This is essential so that you are not panicked and make irrelevant decision in the market when unexpected event occur. Many traders consider candlestick charts more visually appealing and easier to interpret. It makes candlestick a perfect indicator to determine reversal point of support, resistance, or any rebound. Each candle formation at the support and resistance help you to determine possibility of market sentiment has changed from seller to buyer or vice versa. So we move next on what candlestick does not show us. Candlestick do not reflect the sequence of events between the open and close. It is only the relationship between the open and the close. The high and low are clear and obvious graphically, but candlestick no bar charts cannot tell us which come first. With a long white candlestick, the assumption is that the prices advance most of the session. However, based on high-low sequence, the session could have been more volatile. The first candle is a candle that forming a 4-hour time frame. It depicts in only a single candle of 4 hours. We could say the most that the price advanced in price at the session. But this situation depicts a more volatile event on the second figure of 1 hour candle. It can give us more information on the price movement on what happened during the day. With the same event, we know that the price goes down initially on the first candle and going upward to the highest price, then close on the closing price. Although candlestick has limitation of what it can do, but it still offers valuable information on the relative positions of the open, high, low, and close.